So it is my distinct pleasure to introduce today's panelists for you. So in today's session, we will demystify what it means to invest in a startup. We'll kick off with Kyle York, who's the CEO and managing partner of York IE. Kyle will talk about what early stage investing is and why it's a win for investors. He'll talk about how people decide if they should invest in an early stage company and how to balance risk and reward. As we mentioned, Kyle's the CEO of York IE, which is a vertically integrated strategic growth and investment firm. He also was co-founder of York Athletics, which is a third-generation family business, and is managing partner of York Real Estate. Kyle spent many years in tech, including 6 years at Whipple Hill, which was acquired by Blackbaud, and he was CRO at Dyn from 2008 until its acquisition by Oracle in 2016. Kyle has a strong commitment to community as well as supports many local organizations focused on inspiring the next generation. Kyle was also the New Hampshire Tech Alliance's Entrepreneur of the Year in 2021. So you probably saw his name flashing around all throughout the Alliance. Next, Janelle Gorman, she's the CFO at York IE and will go through the next step in the process. Now you've decided you want to invest, but how do you actually do that? How much money do you need? How do exits, distribution, and returns work? Janelle's here to remove the stigma that is impossibly complicated to invest. Janelle's a CPA and is responsible for the financial reporting, analysis, compliance, and financial operations at York IE. Her work extends to the York IE investment portfolio, where she works collaboratively with the founders and entrepreneurs. Before her current role, Janelle was CFO at TRM Microwave and held key operations and finance roles at Dyn and Oracle. The last speaker for today is Kathrine Wells. She's the CEO of Serenity Engage. Kathrine will bring us the perspective of investing in startups from the company perspective. She'll walk you through how to get investment and what you do with it once you have it. She'll dive into when the right time is to seek outside investment and explain the cadence of different funding series. Kathrine Wells is the CEO and founder of Serenity Engage, the go-to platform connecting the entire senior care ecosystem to improve the lives of older adults and those who love and care for them. In addition to her role at Serenity Engage, she's the Chief Inspiration Maverick at Mavericks of Senior Living, a place to bring together like-minded individuals across the senior living ecosystem. Prior to work in senior care, Kathrine spent 25 plus years as a software marketing executive. She also spent 10 plus years as a family caregiver. Caring for her parents both inspired her to start her company and get more involved in creating a future we all want to live in. So I'd like to welcome Kyle up to the stage to get the ball rolling. Everybody give Kyle, Kathrine, and Janelle a warm welcome.
Great. Hi, everyone. Thank you, Heather. It's always so awkward when people read your bio. It's like, it's sort of surreal and awkward. But anyway, really a pleasure to be here. Also very happy to be here with Janelle and with Kathy, who we developed a great relationship with, we'll hear about today. So before I kind of get going, I was going to actually share with the group a story that not a lot of people know about actually how I got into early stage tech investing in my first investment. So flashback, you heard a little bit about my background, but I was an early Dyn executive, and what Dyn did was a lot of internet infrastructure for fast growth tech companies. And a lot of those tech companies just so happened to be founded by engineers. So I would be asked a lot by the engineers we worked with or the domain experts we worked with, how in the world are you scaling Dyn so well? And is there any tips and tricks you could provide for our company? And one of those very early companies was a company out of New York City called Catchpoint, which did website monitoring across the internet. And they first asked me if I'd quit Dyn and go work for them, of which I said, hell no. I'm back in my hometown building a great company, and I'm going to see this through and build something that's really impactful. And secondly, I like what you're doing, so maybe there's a way I could be involved. And so my first angel investment actually started as an advisory gig where the company asked me if I would join their board of advisors and help them with their growth journey. And so I happily accepted that role. That role gave me a little bit of stock options. And 2 years later, the company raised a Series A round from Battery Ventures, which is a tier 1 venture capital fund, managing billions of dollars out of Boston and the West Coast. So I got a call from the CEO. He said, hey, it's been great having you as an advisor. We'd like you to stay involved, but the new board actually wants you to exercise your options, or all advisors to exercise their options as part of the round. Well, the trick with that was, at the time, and again, this is around 2010, 11, and I think I was maybe 29 or 30 at the time. It was $43,000 and $43,100, of which I didn't have $43,100. And so I went to Jeremy Hitchcock, who is Dine's co-founder and CEO, and I said, I know I have a bonus plan, but can you give me a target between now and the end of the year that if we hit it, I can get a $50,000 bonus? And he said, what the hell are you talking about? A $50,000 bonus, like on top of what you already make? Like, that's impossible. You're not going to hit this goal. I'm like, well, give me a goal so ridiculous that if we hit it, I can get $50,000 because I need $50,000. And so sure enough, that was like, give or take, June or July. And we, sometime around October, not December, hit the target, and I got $50,000, and I wrote my first angel investment, $43,100. That $43,100 today is worth probably around $1 million. Company's still alive, it's active, it hasn't sold yet, but it's doing incredibly well, probably somewhere in the 60, 70 million run rate game. And I realized right then, well, shit, if I can afford $50,000 or $43,100 this year, I can afford that forever. And so I budgeted into my life, and I started to create what is now York IE that very moment. So thinking about career and thinking about financial and personal and professional evolution and, building something of impact started all the way back then. When we launched York IE, for me, it was all about how do you merge what then became my moonlight job. I ended up doing 60 angel investments, building a bunch of different investment vehicles, investing in all B2B software with the occasional shoe brand and restaurant and building, commercial building, more of the fun stuff, but really focused on B2B software. And when we built York IE, we wanted to create this model where we didn't have a day job and then moonlight on investing advising, or do investing and advising and moonlight on building a company. We wanted to bring it together. So York IE is really purpose built, and you heard it from Heather, as a vertically integrated strategic growth and investment firm where we provide advisory services in our operating company, a data platform to help companies do market competitive intelligence and growth. And we have a capital pool of just under $20 million a year that we put into early stage B2B software businesses. So it's honestly just a manifestation of my operating career, being complementary parts, technical founders to domain experts from different industries, and my moonlighting career in one. And so we've been able to build an amazing team. We're now over 55 employees globally. We provide help on product development and strategy, go-to-market and revenue operations, and marketing and communication services for the portfolio, but also for any company that needs those services and needs help. And we really are just trying to make as big of an impact as possible. Our number one core value is rising tides raises all ships, and it's a big part of what we're doing. We've always been very pragmatic and thoughtful about investing. There's all types of companies that you could be investing in technology. We avoid predominantly consumer type companies, marketplace type companies, and focus predominantly on B2B software, which obviously through COVID, including this platform we're on now, has become an absolute must-have. For a long time, software on the internet was not, and today it now is. You can go to the next slide. So we're incredibly bullish on this industry. Early stage investing, as you heard about earlier, is clearly very high risk, but it's also very high reward. And there's tons of great benefits to investing in this alternative asset class. So when you talk to like your financial advisor about it, you have the investments that you may have in your savings accounts or in your brokerage accounts or in mutual funds. You have your home, but you bring it all the way back to the alternative class. Some portion of everybody's net worth should be somewhere in alternatives, which again, alternative is private equity, hedge funds, venture capital, loads of different assets there. Again, talk to your financial advisor, but that everybody, I believe, should have some percentage of their overall balance sheet, overall net worth invested in higher risk, higher reward assets. So what's it mean to be a high risk, high reward? Well, when you think about, let's just talk about the S&P 500. This year, we're a little bit down. I think it's currently down like 15, 20%. But most years it's up somewhere in the neighborhood of 3 to 25%. So that means that the investor rate of return annually is percentage points or percentage points down. When you invest in tech startups, what we're playing for is multiples. So what that means is, if we put in $10,000, the hope is that $10,000 becomes 20,000 or 100,000, or in the sake of Catchpoint, upwards of $1 million. The challenge, though, with the asset class is it could also go to zero. So I always tell people that you should be investing the money in this asset class that you do not care about, that you're willing to lose, with the idea that it's high risk, high reward. Obviously, there's loads of ways we'll talk about today of how to invest in this asset class to de-risk the investment. One thing I already mentioned was invest in boring stuff, like, no offense, Kathy, but B2B software. It's way more boring. What Dine did was incredibly nerdy and boring. It tends to be the more boring it is, the more substantial a business there might be. Whether that's the industry, in Kathy's case, that she's disrupting a tech laggard industry, or it's the depth of technology. So this is a really interesting dynamic and really, really interesting times. Of course, the macro economy, I'm sure there'll be some questions on this in the end, has been hit hard. Public market tech stocks are down. The IPO window has been closed. The late stage private equity market is relatively closed. Valuations are getting sort of course corrected, meaning you're seeing less vanity metrics. And I'm a company with $1 million run rate, and I think I'm worth 100 million. It's like, that just doesn't make practical or fundamental sense. This is how York IE has preached, and I have preached for many, many years. For any of you that followed me or us on social media or subscribe to our great newsletter, we've always been about pragmatic, growth and solid business fundamentals, and not chasing the sort of Silicon Valley growth at all costs, venture capital power law game. And so I think a lot of this is rooted in family business. A lot of this is rooted in the fact that we bootstrapped Dine to 30 million before we ever took $1 of outside funding. A lot of this is just rooted in like our Yankee capitalism and just being pragmatic, live free or die, New Hampshireites as we think through this. And we look for aligned founders and partners that we can work with who share in that thesis of building good, strong, healthy companies. For you personally, when you think about valuations and you think about balancing risk reward and you think about value add, no one just wants to be the check writer. I think it's really important for you to, again, look at the whole landscape and play this game, startups and tech investing, long. This is not a short-term game. It's a 7, 10, 12, 15-year hold. I told you my first angel investment, it's up, but it's a liquid up, meaning I don't have that capital, but I still track that asset. And someday that will turn into cash that I will parlay into new investments. So that's kind of the summary from me. I think if I was to leave you with just a few advice points before Janelle gets a little bit more into the details and we hand it to Kathy, to be a good early stage investor, you need to write checks. That's the most, I tweet this every once in a while because I get pissy about it when I see people who are angel investors who write like one check a year or one check every other year, or only do a $2,500 check or a $5,000 check. The reason I think I've done this and succeeded really well at this over the years is because I now have written over 100 plus checks into different companies. I've had over 20 exits. I've been able to parlay returns, which is the second point. Hold those companies, hold those assets. A lot of times what will happen if you write a lot of checks is later stage investors, think like growth equity type investors who usually invest in established businesses, might come in and say, we want to buy out or buy secondary, which is money that doesn't go on the company's balance sheet, but goes to early investors. Well, do you really want to be on the other side of a deal of a company putting in $20 million? But yet so many people say, oh, I can get a 2.5x return. I'm going to take my chips off the table and move on. Well, guess what? You just lost the upside for that to become a 10, 20, 50x return. So write a lot of checks. Remember, it's a long game. Hold those assets as long as you feel comfortable and you believe in the company. And then third, parlay those gains. I think reinvesting. I no longer only do 50K a year. I now do something like 750K a year. And that's because I believe and because it's worked over the long haul, and I have high belief in this asset class, this alternative asset class for the future. So anyway, without further ado, I'm going to pass it now over to Janelle. Janelle's going to get into the nitty gritty of the how and the different options and opportunities. And hopefully, Janelle, you also tell them about our TechWomen Invest initiative that we just launched, because it's well partnered with the Alliance. But I'm really happy to be here and happy to see so many great women and interested in this topic, because there is a major diversity problem in investing and in technology. Kathy will talk a lot about the Lonely Island problem that exists, and we're just trying to do our part to level the playing field for our daughters and future daughters and all different equality across the board. So anyway, thank you for having me, and look forward to questions at the end.
Totally. Awesome. Thanks, Kyle. Hi, everybody. I am Janelle, as mentioned, and I agree the intros are the weirdest thing in the beginning of this. You already know everything about me here based on that nice intro that they gave. So I want to kind of look at some of the information and data behind that diversity problem that Kyle talked to, and then we'll jump into, like Kyle said, kind of the nitty gritty of, well, okay, all of this seems really nice, right? Like, yes, I'd love to invest. You have me, like alternative investments. That's like really interesting. What the heck do I do? What are the basics? So we'll talk about some of that. But in looking at women in investing, I found a great source that Fidelity Investments put out as a women in investing study. And it looks like 67% of women are now investing outside of retirement, which is encouraging, right? It's gone are the days of just kind of popping money into your 401k and, hoping for those employer contributions to match and just see where you get at the end of the day when you're ready to retire. So it's encouraging to see more women investing outside of retirement. You can see kind of by age, the millennials have it a little bit more, but then again, that's a product of appetite of risk over time to when you need the money, right? And we'll talk about that a little bit more. And Kyle alluded to this, a liquid asset, you need time in order to be able to invest in startups. But one in 5 women report making first-time investments in new asset classes this past year. So that's good. So that's saying, again, it's not just 401k or, trying to go and buy a few shares in your favorite company. Women are starting to look at new asset classes, which is great. While that's encouraging, still only 33% of women see themselves as investors, and only 33% of women feel confident in their ability to make investment decisions. So this is a problem, right? I don't know if we have a confidence issue or an education issue or what it is, but we need to talk about it and just get more women at the table investing and understanding what it means to be an investor and what are the risks and how does it work. So education is really an important thing. And then 65% of women say they'd be more likely to invest or invest more if they had clear steps to do so. So at York IE, we see this kind of problem ourselves. We looked around the table at last year's annual investor meeting and said, like, damn, this is a lot of guys. Where are all of the women? And so, we wanted to do something about it. And so we were aggressive. We're always trying to reach out and see what women do we know, who's in the network, who can we talk to, who can we get in the investment portfolio, but that still wasn't quite cutting it. So what we did this year was we launched an LLC called TechWomen Invest LLC that reduces the minimums and reduces the fees to try to facilitate getting more women in our portfolio. So the minimum investment for the TechWomen group is a quarter of what it is in the traditional YR group of investors. And we still have women in both sides of the portfolio, and they're all investors, right? It's all one and the same. They're all at the table. But reducing those barriers to entry got more women at the table, and that's what we need. So we actually have our investor meeting this afternoon, and we have more women coming. So that's a win right there. Is like a 12-month return on our efforts. But we still continue. Yeah, right. We still continue to want to do more. So I think a lot of that is with education and just talking about it and what does it mean to invest and getting these percentages of women that see themselves as investors and feeling confident about investor decisions up. So let's start there. So there's kind of a broad range of access to startup investing. Some are familiar, some may be unfamiliar, right? So that like entry point is that crowdfunding platform. This is like AngelList, right? Where you can kind of go on, invest as little as $100. Anybody can create an account and kind of jump in. There are minimum or maximum amounts of money that you can invest in that way per the SEC. But super high risk, right? Very little control. And when you bet $100 at a time, like Kyle said, your multiples are becoming exciting. Oh, $1,000, right? What are you going to do with that on your biggest exit for a really small investment? The other thing about crowdfunding platforms is you don't have the ability really to get to know the company that you're investing in. They're pretty far away, right? You're just kind of clicking on a name and hoping for the best. And so with that, you end up with a lot of risk, not really being able to do maybe as much diligence as you might want to do otherwise. The thing that might negate the risk is that you're really not allowed to invest much money that way. So the quantity of your risk might be capped. But the qualitative nature of the risk on platforms like that can be pretty high. All that said, I'm not saying don't do that. That might be a cool way to get started, and it's kind of fun, a fun way to roll the dice on startups. And we'll talk a little bit more about the rules around that in the next slide. Investing groups, which is a very broad term, but think like LLCs perhaps, or even the TechWomen Invest group that we've created. There's some buy-ins, right? So depending on the group that you're going to talk to, they're going to have their own operating agreements, and how much does it take to pay to play, right? The minimums could be as low as maybe $25,000 a year. They could be as high as $500,000 a year, plus, right? In order to participate in those groups, you need to have an accredited investor status. And that gets all into the really nitty gritty around SEC compliance and everything that those investment groups need to register with and comply. But that accredited investor status becomes important pretty quickly. Risk control reward here really depends, right? All of the risks on wherever you're looking at for startup investing are going to have that up arrow. Because startup investing just is risky. But as you start to get a little bit more influence and you start to invest in groups that maybe have more of a powerful team behind the diligence process to really understand where is this money going and being really careful and smart and calculated and aligning to whoever you're investing with, that can start to mitigate some of that risk to align more with what you want to see. And then there's direct investment, right? So we'll talk about kind of the rounds of stages of investing. But if you have a great friend who is going to be starting a company and they say, I just need some money to get off the ground, that's kind of the friends and family round, you can write them a check, right? That's always an option. That's where a lot of folks start. Of course, that's going to be high risk because now you probably have a lot of dollars concentrated in a really early startup. So again, that risk arrow is always going to be going up. Control may be up or down, right? It depending on what you get kind of with that check. Are you getting some influence on the company? Or are you just writing a check and kind of hoping for the best and you'll come back around in 10 or 15 years and see how you did? But then reward can be pretty high, right? So that's where you get that smaller check size is going to be really, really valuable when you get into those multiples if you have a winner. So that tends to have, significant capital is required, and then you really need to find that founder and investor match. And those relationships can be hard to come by too for a direct investment if you don't have one kind of on the ready. So kind of looking at some of the regulatory environment and definitions, I think the biggest one you'll hear time and again is accredited investor status. So we can talk briefly here. I put my source on here, which is pretty obvious, sec.gov, right? They're the ones that kind of make and keep all the rules. So please, if you're interested in learning more here, do not bet your life on this slide. Please go to sec.gov and read on. There's a lot there. But because of the risks involved with this type of early stage investing, you are often limited to how much you can invest during any 12-month period in these types of transactions. If you're an accredited investor, there are no limits to how much you can invest. So that's really the difference. The SEC, if you don't meet certain requirements, will limit the amount of money that you can invest in this type of stuff. So the non-accredited investor is determined based on limits on income and net worth. So $107,000 a year is kind of the earmark for that. If you are over 107,000, you can do up to 10% not to exceed $107,000. If you're under that, and see why you can't do this because that arrow's facing the wrong way, apologies. You can do up to 5%, but not to exceed 2,200 in any 12-month period. So the caps get pretty small if you don't get that accredited investor status. Now,
Janelle, sorry to interrupt, but one thing worth mentioning on this too is most companies make you sign an accredited investor form that says you are, because it's if you're a company and you're raising from direct investors, even through a lot of the different platforms, they want all accredited investors in the company because it just helps the company from a compliance with the SEC perspective. The other just like little nuance too on the accredited investor side, I know you're going to that side, Janelle, is like it doesn't include your primary residence. And so this really smacks around a lot of people because like so many, their primary residence is their most valuable or largest asset. So it doesn't include that in that $1 million net worth number. So just something worth noting as well.
Yeah, that's a great point. And I think especially with the way the housing markets have gone now, many of us could be millionaires when we weren't before, just based on the crazy housing market and the value of houses, and that doesn't count. So when you're looking for that accredited investor status, you only need to meet one, and one of those is that net worth greater than $1 million, either alone or with a spousal equivalent, but not including your primary residence. That's a super important designation. It could also be earned income of $200,000 or $300,000 with a spousal equivalent in each of the 2 years and expected for the current year. Or a new-ish change is that you could hold certain professional certifications, designations, or credentials in good standing. So this is like investment licenses, CPA license, and similar things. And if you think you may fall into that, there's a good list of what falls into that category. But just generally to give you the idea of what accredited investor status looks like, that's it. And then typically you're going to just, like Kyle said, have to fill out a form that says, yes, I'm an accredited investor and here's why, and you sign off to it.
Yes, that self-accreditation is important. I think it's a little bit blurry how people sort of define their net worth. Clearly, people are doing tricks in this economy where they're doing cash out refis and loading up the stockpile to invest in this asset class. There's a lot of different things that obviously you want to talk to your advisors about. I mean, if you are a financial advisor or you work in industry, like let's say you work for a venture capital firm or a private equity firm, that's also in that third bullet, and that's new as in like the last year new. So that's the other thing about accredited investor status is this is always evolving. Like different laws are being voted against or voted for to change what it means to be accredited investor. So this is something we study very frequently. And you see a lot of, like, if you go on like a Twitter, a lot of chatter of people thinking this is sort of BS, that the government can control what people can do with their money. These are obviously protections. Again, it's obviously self-accreditation, but it's a moving target. So this is, you could time stamp this meeting and it might change in 6 months, 12 months, 2 years.
Yeah, the other thing on net worth too is like, how do you value some stuff, right? Like, for example, Kyle, you were saying that the value of that asset that you invested in so long ago is upward of $1 million, but could that go away, or how do you know, right?
Yeah, there's a lot of illiquid stuff. There's a lot of estate stuff people deal with. So like maybe your parents are super wealthy and you're named in trusts, but they're alive and healthy and well. So there's a lot of ways, again, why it's self-accredited. Like you might have ownership in a company that isn't planning on selling, or be a partner at a law firm that isn't planning on selling, but you can sort of value it. And again, it's why it's self-accredited. Just know, at some point in time, someone could come and ask you to validate your self-accreditation, and you want to be ready. So don't overly mess with it.
Yeah, totally. All right, cool. A few more like key terms and concepts that you'll start to get familiar with as you continue your research in this topic. So for types of investments, you'll typically see equity or debt financing, right? And so equity rounds, and I think Kathrine talks a little bit about this in her slides, so I won't go too far, but you kind of start with a pre-seed. So that's like your friends and family round, right? Like I have an idea. Hey, mom and dad, can you write me a check? Who do I know that might be rich that could give me a check and believe in my idea? And then you kind of move up to your seed round. So that's, again, still very early stage investors. And then from there, Series A, Series B, how many series do you need to get to be as big as you want to be? It really can vary. What's the latest stage you've ever seen, latest series you've ever seen, Kyle?
I mean, this is one of my favorite, subtweet tweets that I do. I mean, it's ridiculous. I think I've seen G's. I don't know. It's it's a joke kind of. Like whenever I see companies raising DCE, CDEFG, I start to lose my mind that these companies are obviously burning a lot of money for their growth, and they might be getting valued high, but you're not really valued to any value until the company can IPO or sell to a strategic investor at some point. So yeah, I mean, Janelle, it's sort of a joke. And then the other thing is a lot of people do multiple friends and family rounds or pre-seed rounds or seed rounds. So they bury a bunch of rounds into one round, even though it might be 5 rounds. So, it's kind of crazy. Absolute dollars are also something to look at, Janelle, how much money does it take a company to get big? One thing you never know in the TechCrunch headlines is how much money goes to secondary. So again, secondary might go to founders who left, might go to early investors who wanted to sell out. Not all money is primary capital, which goes into the companies in those later stage rounds. Another thing, Janelle, that's super weird is angel investors, the term doesn't necessarily equate to the round, right? I've seen so many people say they've invested in 25 unicorn companies. It's a company worth $1 billion or more. All they're doing is investing through a crowdfunding platform in a company that's a Series E company already valued at $1 billion. It's a very different game for us to invest in Kathy at the pre-seed stage, and then Kathy builds a very large company because you're sharing in the risk at the stage. It's the same as your check size. So this has become super blurry. But yeah, it's been wacky.
And it can be a bit of optics for what the founders want to, what story do they want to tell? I'm raising a Series A, and that means that something for maturity and value, and it comes with a certain reputation, right? And others are no, I'll just stay in seed round forever because I just want enough money to kind of get things going. Kathy, what do you think?
I just wanted to jump onto that. It has become very blurry. It gets really hard as a founder to say, what round am I raising? Because everybody recently in the last couple of years defines it differently. So you have to know your audience the best that you can. And that can be hard to do because VCs they're not always as transparent as the team at York. They put things out on their website that say one thing, and you talk to them and they say, well, here's what we invest in. And it's very different than what they have on their website. Mm-hmm. So, there's a lot of blurriness here, and we'll talk about how you deal with that too.
Yeah.
And Kathy, I know you'll go into it, but if there are any founders also on the call, just raise as little as possible to get as big as you can, yes. That's not always your choice. Sometimes you just need more time. I mean, if you think of capital infusion or these rounds, it's really buying you time to prove out your business model and to scale your business model. But obviously, the goal is to own as much of your company as you possibly can. You're the one, the blood, sweat, and tears in the company. Really, every time you raise one of those rounds, I always say to entrepreneurs, you do realize you're selling a piece of your company to financial service firms, mostly sharks, every time you raise a round. So don't if you don't have to.
Yeah, totally. Yeah, and even to take it to that super high level, you only raise a round if you need more money, right? And so you're selling a piece of your company to get more money, to give more capital and time for your company to grow. If you have, net income and you're earning cash, you don't need to sell more of your company to get more cash in the door. So it's very nuanced, it's very blurry, and it's different for each company. Really quickly, debt financing. is like a convertible note or a safe. These are faster ways for an early stage company to get cash in the door without having really to go through the pain of knowing what their value is right now, how much of the company are they selling. There's guardrails around that, but it basically says, hey, I as an investor will lend you money, and then instead of you paying me back that money, you can give me equity in the company when that debt is due. All right, so liquidity period we already talked about. These investments are highly illiquid. The period to liquidity will vary by investment. It's often 10 to 15 years. It could be as early as 2 years, right? Where the company says, oh, look, somebody just came and wanted to acquire me and I said yes, and here we are, and here's your cash back. But one of the things is you have to be prepared for that to be a long time, but then you also have to be prepared to not have control over when that is. So if it's 2 years, you got your money back. If it's 15 years, you got your money back. You often don't have a say in when your investment will turn back to cash. Valuation and growth, again, these are themes we talked about, but valuations are subjective, right? So this is to say, if you're raising your next equity round, well, how much of the company are you selling for a given price? That will inherently give you a valuation, basically to say, well, what is your company worth in order to sell this percent at this price? There's an inherent valuation. That's subjective, right? That's oftentimes what somebody is willing to pay for it, but that doesn't necessarily mean that's what fair market value may be for it. So a valuation may be different from fair market value. And there's a lot that would go into measuring those two different things. There's 409A studies for fair market value, and we could get into nitty gritty, but we're all just still having our coffee, so let's not go there. But valuations can be tricky. They're often seen as a multiple of revenue or net income, whereas the actual value of what you're holding is much more complicated than that. And then kind of going into tax and other benefits, I hate to say tax before 9 a.m., but here we are. There are some favorable tax treatments that can be available to investors in this asset class. Of course, if you hold on to investments for a period of time in any asset class, you get into long-term capital gains versus ordinary income, which is a more favorable tax rate. But then more specific to this startup industry, there's a Section 1202 qualified small business stock that can give you huge tax savings if you invest in an early stage company, as defined by what the value of their assets are when you invest, and you hold it for a period of time. Lots of rules around Section 1202 QSBS, but the really short answer is there's a lot of tax savings to be had for that treatment. And if you really do dive into this asset class for investing, it's worth talking to your financial advisor about and learning more about. There are some credits available in some states, like the state of Maine is just awesome for tax credits for early stage startup and tech startup. New Hampshire has, programs that are available to support, whether they're government sponsored or program sponsored, right, with awards. And oftentimes those grants and programs might go to the company you're investing in, whereas the favorable tax treatment is for you as an investor. But it's still really great to be aware of those programs, because if the company you've invested in can get funds from the government or grants or programs, then they're going to have more capital to work with to be successful without diluting your ownership as an investor. So wherever they can get capital without selling more of the company is a good thing. So those are some benefits available to early stage that are unique to that industry. Steps to get started, talk to a financial advisor. That's the way to get started, and that's the way to keep going. If you want to invest in this asset class, get a good advisor that's trusted, that understands your unique financial position, your goals, and can create a plan with you. As Kyle mentioned, only invest what you can afford to lose. Your $43,000 might turn into $1 million. Your $43,000 might turn into zero. It's a risky asset class. Understand the investment is illiquid. When you're choosing where to invest, don't just say, oh, startups are great, let's just pick one and roll with it. Know which one you want to get into, right? So know the business, the market, and the people you're investing with. You're trusting the founder and their core team to make your money into something huge. And so you want to make sure that you know where that money is going, and you trust the people that are putting it to work. And then make connections. This can be a more difficult asset class to get into, especially because you want to tie to trust. You want to know the people on the other side, and you want to know that how they're going to be handling that money and how they're going to put it to work. So building connections is a great place to start too, so you can be confident about where you're placing your dollars. With that, I'm excited to hand it over to Kathrine Wells, who is CEO and founder of Serenity Engage, an amazing company, and I won't steal any of your thunder, Kathy. So please.
Oh gosh, steal away. It's a shared thunder here, and I would love to know who in attendance here is a founder. So if you could just put in the chat if you're a founder and if you've already raised money, what stage you've raised at. I would just love to know that as we go through this process. So Janelle, let's see, I think you're in control. So flip it to the next one if you don't mind. And you're going to see here, oh, awesome, Carrie. So you're going to see that their slides were very professional, and now you're going to see my slides that I like to put cartoons in and make it a little silly just to lighten it. This is these can be really tough and emotional discussions when you're talking about this from a founder perspective, because this is your passion, this is your livelihood, you're putting everything into this. And you have to really know how you're going to get there. But a lot of it is the little cartoon there where you say, I have an idea. I am going to chase this car. This is my idea. I think I can get it. Oh my gosh, I got the car. Now what do I do? And that's really what happened at Serenity. We had an idea, and it was related to an experience that I had. Thank you, all my founders who are posting there. I love to see this. So we had an idea, and I'm fortunate. I'm married to a serial entrepreneur and a software developer. I came home one day and I said, I can solve this problem. I can solve this. Can you just give me a prototype? So he built me a quick prototype, and I went out and sold it. And that was the dog catching the car. So I caught the car, and now we're like, uh-oh, we have to build this, and we have to build it really, really fast. So that's what we did. But if you follow on the left side there, this is straight out of Lean Startup. You have an idea, you create a hypothesis. My hypothesis was very, very simple. It was, can I get a senior care community to communicate with me as the oldest daughter, as the daughter in the family, the primary care coordinator, about the care of my mom and dad? That was my hypothesis. We put out an experimental design, which was the prototype. We experimented with it, and we were able to prove it out. So as we proved it out, we said, okay, we've proven this hypothesis. What do? Do we keep going, or do we pivot? In this case, we kept going and we built onto it. And you just kind of keep going through this cycle. But it takes something to take your idea and bring it to the world and see if it's going to work, and be willing to not have it all built out. So many of us are taught that you have to have all your I's dotted and T's crossed. If you're an entrepreneur, you are not doing that most of the time. You are really getting some hypotheses out there and testing them. The other things that I did in this process, I did a ton of interviews. I did over 300 interviews with people across the senior care industry, at every single level and in every single section of the senior care continuum, because there are a lot of players who are taking care of our older adults. So you want to look not just at your core target audience, but the audience around them, and see how you're influencing all of that. Let's see if you could go to the next one, Janelle. So we had this idea, we got it out there, we started to build it, we started to get a few customers. We needed investment. And the first question that you should always ask yourself, and both Kyle and Janelle spoke about this, first ask yourself, do you really need it? Do you really, really, really need it? And if so, why? And ask yourself that 5 times. Why? Answer that. Why? Answer that. Why? Answer that. Ask yourself that 5 times. Make sure you really, really know why you need this money. Because once you take it, you're on the investment train, and you don't get off that train for the most part, unless you're really, really lucky. So as you go through that, And you're also, as Kyle mentioned, you're giving away part of your company each time you take money. So make sure that you're aware of that. So then you think about what milestones will you reach with the money that you take, and how are those milestones going to de-risk your business? As a founder, your job is to continually de-risk the business for investors if you're on the investment train. So as you do that, and there's a lot of resources out there, and I'm happy to share any resources that I have, so feel free to reach out to me afterwards. There are a lot of resources on what those milestones could look like at your early stage and exactly how they will de-risk your business. A lot of entrepreneurs, at least first-time entrepreneurs, which I am one of them. Again, I'm very lucky that I'm married to a serial entrepreneur, so I have that as a resource that's always handy. But as a first-time entrepreneur, I had to learn a lot of this, and I've been in the business world for a very long time. I have been second in command at many startups, and yet when you are the entrepreneur, things are different. So you have to start to learn how to move in and out of different roles. You're the salesperson, you're the marketing person, you're the janitor sometimes, you're the CEO, you're the one hiring, you're the one firing, you're the one talking to investors. These are a lot of different hats, and you learn how to sort of move through them fluidly. The interesting part is the core of your business never changes in that. So the better you know your business, the easier it is for you to move in and out of those roles. When you're looking at getting investment, make sure you ask for enough money. If it's not enough to get you 18 months of runway, really consider why you're doing this, and really consider if you can make a case for asking for more. Every investor is going to look for you to get 18 months of runway out of this. And at that point, they're going to be expecting you to start raising for the next round. So there is this series of rounds that you begin to raise, and they're going to be looking for, what are you doing in this 18 months that is going to get you that next round? Are there alternative funding options? Janelle, thank you for putting that up, because it's actually, grants are amazing. And most states, well, I don't know, I shouldn't say that. Some states are really fantastic. It sounds like New Hampshire is. Colorado also is, and that's actually how I met York. So Colorado, which is where I'm coming to you from, the beautiful city of Denver, the Office of Economic Development has a fantastic grant program for startups. And we were able to get a $250,000 grant here. And in order to get that grant, you had to have twice the money. So we had to have $500,000 in the bank in order to get that grant. So we got the grant first, and then we went out looking for the investment. And that is actually how we met York. And grants are amazing in a non-dilutive way. They also help you really focus on your business, because when you write a grant, you also have to report against that grant. So you have to show that you're able to prove out these milestones. So I hope what you're hearing in this is that everything you're doing for getting money is helping you define your business in the best possible way. And the last bullet point there, craft a pitch they can't say no to. That is the same thing. I used to say, oh my gosh, how am I going to do a pitch deck? I don't know what to do. How am I going to tell this story? And really all you're doing in that pitch deck is showing your business. You are showing that you know your business, you know what you're doing, you know your audience, you know how you're going to sell it, you know how you're going to put this money to work for the investor and make the company grow. So every minute you spend on your pitch deck is time spent investing in your business itself. So spend a lot of time on that. Make sure that you have good people that you can practice on. Practice your pitch deck like crazy. You'll be in the car practicing it, walking down the street, going on your run, on your bike ride, whatever. Constantly practicing your pitch so that it is just innate in you. And as I've said, once you take investment from an investor, whether it's a small VC, we started with a micro VC, and once you start taking money, you're on this train. So you need to make sure that you know that too. If there's a way not to take money, I advise you to definitely look into that for as long as you possibly can. I think it's hard these days unless you have a real unicorn idea. I don't know. So Janelle, if you don't mind, go to the next one. And this graph you can find anywhere on the internet. It's all over the place. It's a very simple graph, but I really just kind of wanted to show you, we get really wrapped up in our early stage funding. In that lower left corner, that is your pre-seed funding. And that is the FFF is friends, family, and what is the other one? What's the other F? I don't know. Friends,
I'm not gonna guess amongst this company.
Yeah, friends, family, and foes. I doubt it's the foes, but yeah, I can't remember what the other F is. So that's your friends and family. That's when you're asking people that you know, your mom and dad are writing a check, or we had a few friends and families come in, or some angels come in. And in this pre-seed, you're really proving out your hypothesis. Pre-seed is pre-revenue usually. So you probably don't have revenue at that stage. You have an idea and you need money to prove out the idea. And then you move to the seed stage, which is you might have revenue, but it's probably really early revenue. And as we talked about earlier, these lines are really blurred these days. So there's not a perfect, there's just, these are sort of general categories. In the seed round, you probably have a little bit of revenue or you're close to revenue, but you really need to help build out that hypothesis even more and show that you've really de-risked the business. And then once you're at about $1 million of annual recurring revenue, you're ready for more growth stage investment. And that is, I would say that's where you have sparked a little fire, a little tinder in the fire, and they're going to come in and pour money on it with the hopes of pouring gasoline on your fire and helping it grow. And I won't even talk about the two later stages because I'm not there. So
we'll get there. Yeah.
Yep, we'll get there. And the interesting thing that I like to say is we get so wrapped up as founders right here and right here because this is our world and this is where we're building the foundation. And we know that whatever we build at this stage is what's going to take us bigger. So you have to build a solid foundation. But in the whole grand scheme of things, this is the very, very early stage. So learn, be good to yourself, pay attention, and use your resources wisely in this process. And then if you don't mind, go to the next one.
And it is friends, family, and fools.
And fools? Oh my God.
Yeah.
It really is. Wow.
It really is. Yeah. So see, we told you it was risky. I mean, Google has validated.
That is very fair. So a little bit of unsolicited advice for my founders out there. You have to be really careful not to compare your chapter 1 to someone else's chapter 20. Really, really important. It's so easy to see these other companies doing well and you're like, oh, what am I doing wrong? You're not. You are in a different stage. So, take heart there. There is no hidden track that you can take for a shortcut. There's no secret handshakes, no magic wands. You just have to do the work. So put your head down, do the work, trust yourself, get things done. They don't have to be perfect, and just keep going. And this is my favorite little image, and I have it everywhere. Just remain curious, remain open, look at things differently, ask people to give you different viewpoints. I want to go back to that, just keep going. I'll just share a story really vulnerably. During COVID, I wasn't sure we were going to make it. And there were days that I would just lay down on the floor in my office in a little curled up ball. And I would have to tell myself, just keep going, just keep going, and say it over and over. And I would eventually get up and I would just keep going. This is a roller coaster ride as an entrepreneur. So be ready for the ride. Just don't get off in the middle of the ride. Keep going, because what you have to offer the world is important and the world needs to hear it.
That's awesome.
And I think that was my last slide, Janelle.
Yeah. So Kathy, I actually have a question for you.
Yes.
If you don't mind. And if any of the participants too have questions, please pop them into the Q&A and we'll see what we can do with our last 8 minutes. But I think it's interesting, working with you kind of you kind of talked about how you found York with the grant in Colorado, and then you had to go and find that match. And so we're lucky to find each other. How does the relationship and we're here, so you have to be kind of nice, but how does the relationship work with investor and founder after the check is written or after the wire is sent?
Yeah, it's communication. My opinion, it boils down to communication, keeping your investors updated on what you're doing, why you're doing it. Ask for advice. These are smart people. They've invested in you for a reason. They believe in you. They've been there, done that. I mean, you heard Kyle's resume. Janelle is an amazing CFO. They have an incredible team, and other investors, I think, have similar, but probably not to the quality level of York. Keep them updated on what you're doing and ask for advice. And I don't want to say get their buy-in, but have them have your back. And it's a relationship that you want to work. It's not a relationship that you kind of get married and then you walk away and you do your thing and then you report in every once in a while. That's not how it works. Some investors are like that, but that's something I would say you should decide what kind of investor you want. Do you want someone who's involved? Do you want someone who's not involved at all? And really know that up front. For me, it was really important to have people who believed in what I'm doing, because I am disrupting an industry in a way that nobody is doing. So they have to be able to see my vision and believe in me during the hard times.
Yeah, Kathy, what I was going to add is, like, there can be no surprises, right? I think for some reason, I think founders and executives like sort of cocoon when things get hard and maybe aren't fully transparent all the time about what's going on, what struggles they're having. And that's both professionally with the business and also personally. Like, if your investors know and you're clearly communicative and there are no surprises, then you tend to align a lot more tightly over time. So I think that's just another key. One thing I want to go back to, Kathy, and I think you're spot on that on the vulnerable side, that like not enough people talk about the struggles in building and scaling and inevitably exiting a startup. So much gets celebrated, and there's a lot of kind of fanfare and stardom around the entrepreneurial community, but it actually sort of sucks. I mean, like, it is so hard to build and scale a company. Something goes wrong literally every single day, if not many things every single day. And even when others might perceive you as a great success, I'll give an example. Back in the 2014-15 time period, Dine was probably in the 70 million, 80 million, run rate stage. And we started to lose alignment with our later stage investors and board. And it was creating a lot of pressure on us as executives. And I started getting migraines, really debilitating ones. Like, if I got them, no matter what time of day I got them, I couldn't wake up till the next day. Like, I had to go to bed and sit in the dark. And, at this time I had a newborn kid at home. It was just really, really difficult times. And I thought I had like a brain tumor or something. I went to speak to, mental health counselors and psychologists. I got an MRI. That was pretty scary, like laying in the MRI bed, examining my brain, begging the technician to tell me if they saw anything or not when I got out. And all it was stress and anxiety. And for me, that comes from a feeling of a lack of control, right? I've learned about myself that if I don't feel like I'm in control, or I feel like I'm losing control, it creates a lot of pressure and stress and anxiety that I wear and maybe internalize. Maybe talk about with others, but I wasn't dying. I didn't have brain cancer. I just was super stressed. And I think I've had, like, since that time period of my life, maybe 2 migraines since in the last 7 years, right? So it just goes to show that this thing is really, really hard, and we were already at a pretty big pinnacle back then, but the pressure can truly mount. And again, not enough people tell those stories and share that, like, kind of mental health challenges that goes with building and scaling and operating and eventually exiting these companies.
Agreed. And let me add to that. Thank you for being so open about that, Kyle. I think it's really important that people do talk about this. And for you founders who are looking for investors and investors who are looking to invest, be the kind of investor and be the kind of founder who looks for someone that you're willing to share those things with. I certainly have talked to Kyle and the team when I have been in the dumps, and they helped buoy me during that process because they still believe in my idea. They didn't take that one moment and say, oh God, she's never going to make this work. We're leaving. You got to get that out of your mind. You're in a relationship with each other. And if you don't have investors who know that this is hard and are going to be with you during that time, you don't want them as investors. Trust me.
I don't want to like knock it too bad, but the venture capital community is pretty brutal. Like, I mean, it's the client of a venture capital firm or a private equity firm is their investors, right? So their model lends itself to financial returns. And so like, and they're typically finance people, not with all due respect. Janelle's a very friendly finance person, but they tend to be very black and white, and like an engineer, maybe don't have the EQ or the communicative skills to kind of adapt and evolve to that. So I think that's also plays into it big time.
Sorry,
one last thing, Janelle, real quick. The other last thing I wanted to mention just before I forget, Kathy, is I remember the one of the psychologists I was talking to at the time, or I can't remember exactly her clinical degree or whatever, but she wrote on like a pink Post-it note, and she just wrote, put this in your pocket or your wallet or your laptop bag and carry it. And it just said, see and feel your accomplishments. And it was like, and it's like such a silly little thing. And I still hold it because it was kind of like when you're in this ride, in this journey, like you lose a lot of perspective because it feels like the walls are sort of collapsing on you a lot. And I just remember that was like a really interesting thing, like see and feel your accomplishments. It was like so basic, right? But it was like, oh my God, I never see and feel my accomplishments. I think I suck. I think I'm a failure. Like, right? And of course, there's a double-edged sword to that. It's probably why I'm successful. But you can't like, not kind of do that.
Yeah.
Sorry, Janelle.
Yeah. No, you're good. I think we're up on time anyway, Heather. I think we could talk all day. But I see your face here now, so that makes me think that we actually can't.
Yeah, I know. I would love to. Oh my gosh, yes. Great information. Thank you all so much. We are going to keep the room open for another half hour if any of the panelists can stick around if people have some questions, because there were a couple of questions in the Q&A that we didn't fully get to. So feel free to look for them at the table. And let me just say thank you so much, Kathrine, too, for Colorado, for making that very early morning for you. I appreciate that. So we have Colorado. We have Valerie here from DC. So our little TechWomen thing has definitely become national. So I appreciate it. Wonderful information. Thank you all so much.